This is the Self-Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self-Storage Podcast. I am your host, Scott Meyers, and today we have a returning guest, Mr. Brian Martinez with NuView Trust. Brian, welcome back to the show.
Hey, Scott. Thanks again for having me. Anytime. I'm happy to be here.
Well, as you and I have been discussing both on our last podcast as well as in general in our conversations, the market is changing, and we are seeing an awful lot of interest in your services with self-directed IRAs. As people are coming out of Wall Street and they are looking to put their money into hard assets and income-producing assets, which we're thankful for because self-storage is one of the top producing and performing. And so we've had an awful lot of interest in our asset class, and we are raising a lot of capital. But I thought we wanted to dial it back a little bit and talk a little bit about, from your standpoint, Brian, from what you're seeing on the NuView Trust side. A lot of folks come to you, they set up an account, and then the first question is, what do I do? Where do we go? Of course, you're precluded from guiding them because that's not what you do. But if you could, why don't you talk through some of maybe the challenges, or at least some of the top questions that some of the folks have, and let's kind of maybe pick through and see how we can address some of those questions, because there's many folks that are here within Storage Nation that are either already or looking to invest passively that probably are wanting the same thing. So what are you seeing on your end?
So, the biggest thing we're seeing is a lot of these newer clients, they're moving their cash over. Their financial advisors are more upset with them than happy with them doing it because now they can't manage their portfolio. And then the client's kind of stuck in this limbo where they're like, okay, now I have my cash available, but where do I invest it? And you're correct. We can't really direct the client on what to do with their money, but we can teach them how they can do diligence and ask the right questions, figure out what asset class they want to invest in. These are definitely passive investors. These aren't the ones that are looking to buy that one rental property and have to be a landlord. They just want their money to perform better than it is in the stock market right now.
I'm a client. I'm a new client, and I just set up an account, and now you've just told me that you can't assist me because you don't do that. So where are you going to send me to do the due diligence? Where should I be looking to find these other alternative investments to be able to begin vetting the sponsors and looking into the products or these other investments? Where are you typically sending folks?
So yeah, that's a good question. And we're stuck in a rock and a hard place. We want to be able to help the clients and have a solution for them. So what we have done, and this is something that we've invested a lot in, is time and energy into a marketplace where it's still up to the client to do their due diligence, but we can direct them to where they can go with some of the assets that we have onboarded. This has not been rolled out yet, but it's in the works, and it's going to make things a lot easier for the clients to identify what investment they want to make and what type of assets they want to add to their portfolio to give them that diversification that they want into these performing types of alternative assets.
Well, and we're looking forward to making that happen, as you and I discussed off camera as well. So now when folks are out in the marketplace, whether they're looking at something that is on your side on a particular site, or a friend of theirs has recommended a particular space that they should begin looking into, let's first discuss that the wrong answer for folks is to sit with their cash on the sidelines. Analysis, buy paralysis. It keeps people from getting in the market and making the returns that they want. And as we've seen right now, inflation with a reported 9% by the government, but when you factor into all the increases in fuel prices, housing, and everything else, it's really in the mid-teens. And so these folks, they need to put their retirement dollars to work, or else they're going to be going backwards really fast. And they really need to be producing returns that are higher than those mid-teens. And so speed is the name of the game. So in order to get into the game, they need to pick a performing, let's say, whether it's a REIT or a single asset, single entity, syndication, like what we do. We also have a fund, whatever it is, precious metals, whatever it is that they're looking into. They should start with the sponsor, and the sponsor should have a good track record, have a good reputation. We want to flesh out as much as we can online if there's any bad press or any negative press that this company or the individual may have. But what else should they be looking into in terms of the sponsor to know that, hey, this is a good horse that I need to hitch my wagon to and to spend my investable dollars with this person or organization?
Yeah. One of the things I tell my clients when they're doing their due diligence is create a checklist. What is it you're looking for? What are your expectations first off? What type of returns are you? They have to be realistic, of course. And then who is it you're working with? Build that relationship with them, get to know their track record, see how long they've been in the industry. Knowledge is important. If they've been through a recession, that's huge because now they're prepared for that and they leave their investors hanging. They know that investors are number one, and there's always a way to get either liquid or move the asset or sell an asset when the right time is to make those moves. If a recession does happen, some people say we're in a recession right now. I don't feel like we're there, but we're pretty close, and hopefully things start to go back in the right direction. Also, transparency is really important. Ask for all the documents, ask for the sponsors. They do due diligence as well, and they're usually happy to share their due diligence with you. And that'll help you, put all the pieces together and even understand what you're investing in. You will learn so much more if you're more involved in the investment.
We have a number of folks in our education organization. We teach people how to invest in self-storage actively as active investors, how to develop, how to acquire, and we spend a lot of time on the underwriting piece. We spend a lot of time on how to structure the capital and anything and everything that goes into how to find, evaluate, purchase, and manage a self-storage facility, as well as the development side as well. All those. We find that also then there are many folks that recognize that, I think I was going to do this part-time, but it looks like it's a little more involved than what I had anticipated, a little more work. And maybe I don't want the lease-up risk. Maybe I don't want the loan risk in going forward with this project. And I'd just rather invest passively. And we find a number of folks that look to do that. And our stance is, well, you still need to know all of those steps. If you're watching a webinar, if you're looking at an offering memorandum, and you're looking at the underwriting, if you don't know anything about the asset class or really about some of the baselines and the norms in terms of ratios and percentages from income to expenses to just all of the expenses, you're kind of flying blind and you're just assuming that the numbers that are presented in the offering memorandum for this investment are true to form and this is the industry standard. So, we make in our portal, we absolutely make available to all of our passive investors a shared folder that has all of the due diligence items in it. They can see anything and everything that we see to evaluate an investment before they're putting their dollars into this project and signing on the dotted line. And quite honestly, Brian, I'm a little surprised. Put it this way, I'm thankful that many of our investors, they know us and they trust us enough that they don't do a lot of due diligence, but I'm also surprised and wish that they would do a little bit more than what they actually do. Because obviously how you stay out of trouble and whether you're active or passive, you still should be doing all of that. But it's a good point that you make several points that you made. First of all, one is that there's a whole folks out there that have had the wind in their sail at their back for the past 10 years in this great recession. There's a whole lot of folks that look like heroes. And when you peel back the onion, 50% of that was really the market. And how strong were they? And have they, as you mentioned, been through a recession or two? And I believe I personally wouldn't invest in any company or with any person or individual if they hadn't, because this will be our third. We've been through two now, and we know what it looks like and what to expect. We've been preparing for it. We've weathered those storms. And so, we're in a little better position than many of the folks out there. Mm-hmm. And have they exited profitably? There's a whole lot of folks that can raise a lot of capital based upon projections. But as you also mentioned, Brian, anybody can put a number out there for an IRR, 25, 30%, and that looks really attractive, and they'll attract some folks. But have they done this in the past, and have they hit their marks? And have they hit those projections, exceeded them, and then have they made distributions to their investors? That's a whole different story. And so I would just add that these folks need to be, anybody that you're looking at and sending over your investable dollars they should have been through a recession. They should have successfully either acquired or developed and then exited profitably and either met or exceeded their investors' objections before I would ever look at spending any money with those folks. What would you add to that?
No, I mean, you took the words right out of my mouth. Exactly. Find the people that have the longevity in the industry, that have weathered the storm, and you're still insured. Get testimonials from their clients. Go to the Better Business Bureau. Check. You could just Google somebody's name. You can Google their fund. Everything's really on the internet. It's black and white, and it's always up to you to do your due diligence because it really is up to the investor. It's not up to the sponsor. It's up to the investor to do their homework before they make any investment. If you need to get legal advice, seek that legal advice before you make it. If you want to speak with your financial advisor or CPA before you do it, do those things. That's part of your due diligence and your responsibility if you're self-directing. So self-directed, that's why it has the word self. You really take on the responsibility to make those types of decisions. So like I said, we could put these investments in front of the clients but it's not our responsibility to say this is a valid investment or a good investment or a bad investment. That's not our job is. What we are is just the custodian. So all we do is what our clients tell us. They want to put their money somewhere. We review documents. We make sure they're in good order. We make sure everything's titled correctly. And then we send the funds out. Now the client's made their investment. We didn't pick the investment. They did.
Well, so one of the pieces, and I'm sure it's a question that you get as well, is investigating a sponsor or a particular type of investment. When folks come to us and they are interested in the types of investments that we have, they usually fall into one of two camps. When we have an introductory call with them to find out what their investment needs are, it's usually they're looking for cash flow to replace some income that they had, and these dollars were put to use somewhere else that were producing income, or now they may have lost their job and they now have their dollars from their 401k from that organization, and now they need to put it somewhere to earn some money for them until they find a replacement job. Or many times they're looking to use this money to bring more income in so that they can bring somebody home from work. So one of the income earners in the household can stop working. That's one camp. The other camp is wealth building. They're just looking to supplement their retirement. They don't care about depreciation pass through to their tax return on their K1s. They're just looking for the big hit. It could be 3, 4, 5 years down the road. They don't need the cash flow in the meantime. They're just looking for maybe a little more risk, but a little higher return on the back end. And it's important for us to guide them in that direction. And I know that you're not guiding them as well, but the important piece, that the overarching piece to this is if you're sending folks out to a sponsor or to go out and look in the marketplace, and for those of you that are passive investors, if you're talking to a sponsor or their organization and they don't even ask you that question, then that should throw up a red flag, because it means that they've either only got one type of investment, and it may achieve one, it may earn some income, or it may not. But if they don't never bother to ask, and they only got one flavor, and they never determine what it is that you need, and they say you're looking for cash flow, but your investment doesn't really provide cash flow, it should be a red flag. And that there should be a person on the other end of the phone that is talking with you about, what are your investment goals, and to see if there's an actual fit. Because other folks, they're not very good at raising capital, and they're just happy that you called them, and they're going to do anything and everything in their power to get you to invest or persuade you to invest in their project, and it may not meet your needs or goals. So Brian, any comments on that, or how would you answer that?
Yeah, I mean, my comments on that are definitely, they should be asking those questions before you make any investment. Like I said, that relationship is the most important piece. You know what I mean? This is a person responsible for holding your money. Not only that, investing it the right way and having an out for you just in case things do go south. What is the strategy to get out of the investment? And is there cash flow coming in? Those are important things that you want to ask. And as the sponsor, if I was making the investment with anyone, I want to make sure that our personalities work well together. I want to know what their track record looks like. How many investments have they made? How much assets have they had under custody? What is the net worth basically of their portfolio, because they have a portfolio as well. So those are important things I would like to know if I was making an investment as a passive investor. Now, being in the industry as long as I have, I know what questions to ask, but somebody brand new wouldn't know these things. And that's what I appreciate about, self-storage investing with you, Scott, is that you're transparent. And not only that, you have options for clients. Not everyone's accredited. So you have created a fund. That fund is open to those people that aren't accredited. And eventually, maybe they will become those accredited investors. And they're not going to be limited to those syndication deals that they can directly invest into. But you have options for people. And I appreciate that. And I love that people want to take that in consideration, that not everyone is accredited, but everyone should have that ability to be able to make these type of investments.
Well, that having options is obviously key. Otherwise, if you don't go down the road, and they may not come back. And so and if that is the case, at least you guided them in the right direction. And so we would never put somebody into an investment that it doesn't make any sense to them. It doesn't meet their needs or goals. Part of what my team has been instructed over and over again in training them. And that brings me to my next point, which is a team. There are an awful lot of folks out there in your industry as well that may have some folks working for them that are just getting started in even building out a self-directed IRA company. And I know some folks that their job as NuView does, but they're beginning to get into your line of business, call it your competitors, and they're a person with an assistant. And probably not the best place to go to set up your self-directed IRA. And the same goes for the sponsor. If that person is doing everything, investing in the project, raising the capital themselves, and trying to keep both things going, and having the compliance on the back end, and keeping on top of the investment and growing the net operating income to produce those returns. Or if they have a really small team, that may throw up a red flag as well. So tell us a little bit about what that looks like on your end, Brian, as far as investing with you versus maybe some of the startup shops that do similar things to what you're doing.
Yeah, I'm kind of torn between that, because there are some people that have taken mastermind courses and they've learned, and they're just doing their first deal, and they might have better offers where they can give you better returns because it's their first deal and they don't have a whole lot of investors. But it's also a gamble because they're not as experienced. So it's really tough. Yeah, the returns might look better, but do you want to really put your money with somebody that doesn't have the experience? That's where you have to find that balance. And one thing I tell my clients is, once you've made a good investment, you've gotten the returns you're looking for, you can always rinse and repeat with that same person, that same sponsor over and over again. And so you're ready to retire and you need to take those funds out. I mean, keep that money working for you once you build that relationship, and you only need a handful of good relationships out there, really.
So what does that look like on the self-directed IRA side? You've got an incredibly experienced and professional team on your end when investors are looking to work with the NuView Trust, or that person that I mentioned, maybe just starting out in the self-directed IRA space. They say, hey, this looks like an easy company to start. I don't have to have a lot of employees. Maybe I can get an assistant or somebody to answer the phones and do this. What are some of the pitfalls that somebody may find when they're looking to set up a self-directed IRA account with somebody like yourself versus another company, which really isn't a company, it's just individual, if you will? What are some of the pitfalls and gotchas that they may run into?
Well, NuView's been in business since 2003. We've got $2.4 billion under client assets. And we have specific departments to help you depending on what your investment is. And we love being able to do the handholding for those people that have never done this before, because not a lot of people know about self-directed IRAs, and we do our best to bring awareness to it. So you want to find a company that's okay to do the handholding. They're going to be responsive to your emails or your chats, or just downloading an e-guide. They're going to reach out. They're going to be proactive, and their website's easy to navigate. We have so many training videos, and I think that's what really makes us different from our competitors, that we educate the clients on how to use the client portal, how to fill out documents, how to fill out the application. And if you still can't watch the video and understand it, then pick up the phone and we will walk you through it. We love setting appointments for walking you through the documents. But once you've done it the first time, it's like riding a bike. It's really not hard at all. And all you have to do is to take that first step of getting that account open. The number one thing I hear, and I've told you this before, is I talk to people today, and then a year from now, they call me back and they're like, wow, I should have done that a year ago. Why didn't I do it sooner? And you tell people all the time as well, you should have done it yesterday. And people are kicking themselves in the butt right now. The market has not performed. And I mean, my phone has been blowing up with people panicking, crying. I mean, you name it. They're like, why didn't I just go with my gut and open my account? My spouse talked me out of it, or I was still at my current W-2 job and my money was tied up. I left 6 months ago. I should have transferred then. I didn't. Things like that. Those are probably the most common pitfalls that I see. And it's more the clients not taking the time to educate themselves. And even if you're moving a little bit of cash over, at least you have the account open and you're ready to move more when you're ready. That's what I would say is the best advice I can give anyone, is get the account open, move a little bit over now, have that at least ready to go. So that way you don't go through this stock market experience everyone's going through.
Yeah, having cash available to deploy is especially important in the market that we're heading into right now. This is where opportunities are created, and they come up all the time, and they will begin to increase in number as we head into this recession. And so, yes, it is time to have those dollars available and ready to deploy as soon as possible. So do not wait. And our folks echo the exact same thing that you just mentioned, Brian, which is we did a poll a number of years ago with our students and folks that we consult with in the business, and I did a test to see, what are the top 5 gotchas, pitfalls, and mistakes in your investing career. And these are active investors. And number 1 was, no surprise, wish I would have started this sooner, and being able to direct my own future and be able to take control, because it does make a huge difference. So let's continue on with in the team mode. Folks that are looking at working with various sponsors or syndicators, it can't be a one-man show, again, both on your side and on our side, because if something happens to that one man, I learned early on in my career, the first syndication where one of these investors was a little more savvy and had some really good questions, and one of them was, hey, do you have key man life? And I'm completely unfamiliar, and so any good syndicator, I said, I believe I know the answer to that, but I'm going to double check before I don't want to give you the wrong answer. And so as I looked into what that looked like, if I get hit by the proverbial bus or any syndicator gets gets hit by the proverbial bus, who's going to take over and continue to drive the performance of this? And if not, is there insurance in place that makes us whole? And so for that reason, if there isn't either a clear number two, or if there isn't some way so keeping on life insurance to protect an investment, I think that is key as well. So something else to look out for. And in addition to that is, even if a team has not been built out and vetted as far as a sponsor or syndicator, who are they using for third parties? Are they bringing in consultants? Are they using other vendors, say, to maybe even do the due diligence to perform the initial underwriting or on the back end, proofing your underwriting to make sure that as a sponsor or syndicator that the underwriting is solid before you as the passive investor then invest in that project. So what is their use of outside vendors? And continuing along that thread, vertical integration is very good for all of us because it reduces costs. If we can build these different areas of our organization and these different departments that we have control over, it reduces costs and allows us to make sure that things are done correctly, because nobody cares 1% as much about your investment as you do. And so that means you're going to put the right people in place to manage the various areas and departments that it takes to run a successful syndication, self-storage, and development, and management operation. But if you don't have that, who else are they bringing in outside that is the best of the best until they build that out? Or if not, and they haven't, and you can't tell that they have that all completely built out on their own team, are you at risk? It's a little difficult to discern, but those questions are any passive investor should ask of a promoter or a syndicator. And if the answer to that question or any of the others is, well, and if that answer comes up 1, 2, 3 times within a conversation as you are interviewing these sponsors and syndicators, that should also be a red flag that perhaps they don't really have everything in order, their house in order, before investing with them. So, Brian, what else does that bring to light as far as on the passive side that people should be looking for as they're, once again, now heading out for the first time and looking to invest passively in the marketplace?
I didn't even think about what's the plan B. And you brought that to my attention. Like, that's a great question to ask. And I'm definitely going to start asking that question myself and tell my clients they should be asking that question as well. But another thing I look for is, do they have an online presence? Podcasts? Are they even guests on podcasts? What does their website look like? Is it well put together? And you should be asking who else is on the team? How big is the team? Who does what on the team? You should know all of those things. I think those are very important things to know, and build relationships with them as well. They might not be your go-to person, but at least you know them by name. It might be a huge deal where there's thousands of investors, but you're just as important as the next investor, and you need to be treated that way.
Mm-hmm. We've been at this game for 17 years now, investing in real estate, and been in self-storage for 15. And we began syndication and doing private placements about 12 years ago. And recognize very quickly that in order to attract more folks to be able to partner with us and come alongside and invest with us, that we need to get word out about what we're doing and about our successes and sharing our wins, as well as being humble about our failures and what we learned from them as well. And in today's world of social media transparency, if you have investors that are displeased with you, well, guess what? They can go out there and voice their displeasure. And so there's this accountability that is there whether you want it or not. And the syndicators that aren't doing well, they're going to be found out. And just like anything else, you find on Airbnb before you book that rental, that short-term rental, that you look through the reviews and see if people had a good experience or a bad experience. And if they had a bad experience, you go elsewhere. And this is no different for us as well. So we're very mindful of that. Not that it's ever been an issue. I mean, integrity is at the top of everything that we do, and we're a Christian-based company, and our focus is on missions, and we can't do that or anything else and provide for employees if we're out there stretching our projections or doing anything nefarious. And on the flip side of that, what I found, Brian, is that there's some folks out there that, surprisingly enough, as of the Jobs Act and the 506 Reg D 506C, you can advertise your investments. That was enacted. And so you can promote that publicly as long as you take in accredited investors. Yet I found a couple of promoters or syndicators that you can't find them anywhere. They're not on LinkedIn. You can barely find their website. Their email address isn't tied to their company. And then, lo and behold, months or years later, you found out that, it's because they're not nice characters, and they've somehow been able to raise capital other places, but they never put themselves out there. Therefore, there's no accountability or a reason for anybody to go online and find anything bad about them. So that is, I guess, another pitfall, gotcha, or something to look for when beginning to invest and looking at a promoter or a company. What is their presence? Do they show on their website? Do they show a picture of their team? Do you even know who's at the head of it and who the support staff is? If they've got the picture of 10, 12, 100 people, they're all smiling in a professional photo, pretty good chance that they're doing what they say they do. If it's a one website and you don't know if there's one person running it or 10 or 5 and there's no contact information except for an email address that says info at, that's usually a red flag because people want to see reviews. And as you mentioned, Brian, testimonial, that is one of the best ways that you do diligence on any company, whether it's a self-directed IRA company like yours to work with or a syndicator, is your testimonials are your business. And so if they don't have them or any way to find them, that may be a red flag as well. What are your thoughts on that?
No, yeah, that's exactly what I was saying. And I wish I could tell you more stories, but I've had people say they are other people on LinkedIn and then you look them up and it is not the same person. So you really have to be very careful out there and do your homework. That's all I can say. There's not more to it. Is go with your gut, do your homework, seek legal advice if you need to. Ask your self-directed IRA custodian. Obviously, that's important, especially on the sponsor side. What we do is we do a little bit of due diligence. We do some research on the fund or the offering. And if it looks legit, we review the documents. They look good. We found the person online. There's no red flags. We onboard the QSIP and now the offering's done. Doesn't mean it's a valid investment or it's a good investment. It just means that we did not find anything bad on the background check that we did. That's all it says.
Perfect. Well, Brian, I think at the end of the day, it is about doing due diligence, not before investing passively, not only on the asset class, whether it's real estate and a particular type of real estate, but whether it's a precious metals or a startup or hydroponic farming or whatever that looks like. Is it an industry that has a lot of good press? And are you seeing that it's taking off and you've got some stats to back it? But then who is driving this company that is in that asset class and that investment? And what is their track record? Do you find anything bad about them online? Do you find anything online about them? But more importantly, do they have those testimonials and customer successes that you can point to with stats, whether it's audited financials or unaudited financials, but they show a track record of being able to produce income as well as then returns to their investors from front to back from the time that they brought those dollars in. They hit their marks. If it was a 5-year hold and they exited in 4.5 or 5 and they hit their projections or beat them, you can't stress that enough. It's one thing to tell a good story. It's another thing to be able to execute and actually show the results that you actually did what you said you were going to do 3, 4, and 5 years earlier. If the folks are new and they haven't been through that, it's somebody that's only been in the business for 6 months or a year or 2 or 3 years and they haven't exited anything. To your point, Brian, it doesn't mean that you shouldn't invest with them. It's just that there is a little bit more of a risk there, especially if they're offering higher returns, because many folks, when they are starting out, they don't have the track record to go on. And so they're promising higher returns in order to attract capital to get their fund filled and get their deal funded. Now, whether they perform, that is another story. And maybe they're giving up more equity on the first one so that they can do so. Or if they're still looking at a 50-50 split with some high returns, you need to look at the math and do your underwriting and understand the industry and how it is valued as well. So anything else in summary, Brian, that maybe I left out that folks should be looking for before they begin to go out and start utilizing those dollars they put with you into the market?
So my final thought is just figure out who your sponsor is, get involved. They have events, attend the events, show your support, share their posts, because the bigger that network and the more investors that they have, it's going to help you as well grow. It's going to help you build your portfolio. They're going to be able to find more deals that you can take part of. Also, building a relationship with your self-directed IRA custodian, log into your portal, check your emails, make sure you're getting your returns on time. That's really important. Make sure your sponsor is also responsive when you do email them or you do call them. How long does it take them to get back to you? That's important. We all just have to support each other, build each other up, and that's how we all win at the end.
Hey, very good point. Very good point, Brian. We have an awful lot of folks that we do regular communications with. We send out monthly financials. We have a quarterly webinar and Q&A along with that. We record all of those and put them in our portal. At the end of the year, the folks said, "Hey, I haven't heard from you, and when are my K1s coming?" I was like, "Well, we told you about every single month and every quarterly webinar when the K1s are coming and all the updates on the project." And so doing that and all the referrals that you mentioned as well, going to the events, getting plugged into what they're doing, if they're holding events, getting on the webinars and then referring folks to them as well, you make that project, that sponsor, stronger by more dollars you attract and bring into that investment as well. So be engaged. Even though you are passive, the least that you can do is continue to get engaged, communicate. And if you're very well versed in the industry and that's why you're investing in it, then there is nothing wrong with reaching out after one of those quarterly webinars or just by email to say, hey, here's something I saw in the industry. Just wanted to know if you're aware of this. It may help us in our XYZ investment. So be engaged. As a sponsor myself, I welcome that. We keep our ear to the ground. We're in this business and in the trenches day in and day out. And we got a big team that's looking at anything and everything. But it doesn't mean that there isn't somebody else who also has their ear to the ground that found something or heard something that they recognize that can benefit the industry and therefore their investments. And so we want to hear from them. So all very good points, Brian. Well, my friend, I appreciate you and NuView Trust and everything that they do and have done for us as well as for our clients and especially for your time today, Brian. So before we leave for today, first of all, tell us what you're reading. Anything that you want to share with folks that has been on the top of your either audiobook or your reading. Oh, look at, he's already got it right at the end of it. That's there. Well, let's do that first. What have you been boning up on recently?
Actually, I'm reading the Definitive Guide to Underwriting Multifamily Acquisitions. I just want to learn about underwriting and how to read the sheets better for myself when I'm doing my due diligence. And I think everyone should. And it's a real easy read. It's not a big book. High level, yes. YouTube, you can download templates. You can play with the numbers a little bit. But if you're able to grasp it, it's a great book.
Yeah, we've added a piece recently. We just did a session, a recording about, I may have coined a new term called dynamic underwriting. We've had dynamic pricing in our industry for a number of years now, really following the airlines. As the tickets and the seats book up closer to the flight, well, the prices go up. And we're doing the exact same thing in self-storage. And as we're running out of 10 by 10s, the price goes up for the next person in line. Yeah. It's just normal supply and demand. And now the software and the technology in our industry is caught up to that. Mm-hmm. But in looking at our dynamic underwriting past, the industry hadn't changed too much. It was pretty static, and we knew and we could predict with a fair amount of accuracy what our lease-up percentage rate is going to be each and every month, how many units and what percentage of occupancy, and how much on an annual basis our expenses would go up. So our income goes up 3% and our expenses go up 2.5%. And so we would underwrite to that, and the banks would typically accept that because that's what they would do as well. And a management fee would be 6%, 5%, or 6%. But then in reality, what we're seeing is that management isn't just 6%. If we're spending a large amount of marketing dollars to get people in the door, that means that there's an additional expense. And yes, it's on the marketing side, but on the management side as well, for folks to be there extended hours and for the call centers to lease that up. And so it's dramatically higher those expenses are in that first year during a lease up without the income coming in. And our expenses, they don't normally just go up 2.5% for the 5 years that we've set out for this project. Supply chain issues and your construction costs double, and our payroll goes up by 50 or 60%. We no longer have these flat line straight percentages. We're really putting pencil to paper and dialing in our underwriting and being realistic and from a month to month to a quarter to quarter basis to make sure that again we're budgeting enough for it. Ultimately, that we're hitting our projections and that our folks know just exactly what to expect and that we either meet or exceed those expectations. And that doesn't come with just some really easy or lazy underwriting. Is probably the best way of putting it. So yes, Brian, not only for yourself but anybody that's looking to invest in real estate or any business, whether it's underwriting and you're looking at an line a cap rate for valuation or working with a small business and EBITDA and looking for earnings before interest, taxes, depreciation, and amortization. And if it's a small business and you don't know how to calculate EBITDA or even what it stands for, you should probably learn yourself up on it before you begin investing in it as well.
Yeah, it's just going to make you a better investor at the end of the day.
Absolutely. Brian, once again, thanks so much for your time. How do folks get in touch with you and NuView Trust?
Thanks, Scott. It's always my pleasure. Enjoy your company. So you can reach me at bmartinez@nuviewtrust.com, or you can reach me at my direct number, 407-519-9172.
Great. Thanks, Brian. Always a pleasure. Appreciate you and looking forward to the next time we get to chat either on a podcast or in person at one of our next events. We'll see you soon.
All right. Thanks, Scott.
Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.